Happy new tax year. Okay, it's a naff accounting joke, but watch on. As a business accountant, my team and I spend all day long helping business owners on their journey. And of course, one of the key things we get involved with is tax efficiency. You only really want to be paying exactly the tax you have to and no more. And as a result, there's a lot of things you can do to kind of maximize that at different points of the year. And I think it's always exciting for us tax geeks when the tax year changes, because you get all your allowances reset and there's opportunities to look forward into the year and think, okay, what can I do? Now you might be thinking, well, why are we talking about this by the time this comes out into the middle of June? And that's because I think sometimes, especially with what was announced, and we talk about it with national insurance changes and things, it made more sense to do this video a little bit later, and there's plenty of opportunities still out there. And in this one, I'm going to cover both some opportunities and some real basics, I think, that you just need to be aware of as you go through the year. And that's whether you're limited company, sole trader, personal tax person, whatever the reason you fill a tax return in, there's going to be something in the video for you. And what I would say is that kind of just don't skip the bits. When I say, oh, this is about limited company, just listen in, because if you're a sole trader, some of those points I'm going to almost mention again, and you might get a better explanation the first time I talk about it than later on in the video. So do check that, because, and also I think it's worth, especially if you're a sole trader, hopefully if you're going to be super successful later on, you might want to transition to limited, and it highlights some of the key points there that is worth being aware of. So before we get into it, if you like these type of videos, make sure to click the subscribe button and the bell below so you get notified whenever we release more videos just like this one. So let's talk about general stuff then first. So generally, when you have to do a tax return, always do it early. Don't leave it to the last minute. So we get to the 5th of April of a given tax year. So we've just done the 5th of April 2022. So now your tax return is open. You can go and do it. And it doesn't have to actually be in for most people until the 31st of January next year. So you think, oh, well, I've just got ages to worry about it. But, big thing, the tax bill that is due is going to be payable on the same day. So you see a lot of people, they wait until the last minute to do it. And then they're really surprised when they've got to pay tax. And they're like, oh, you've got no money, so there's no time to plan. So that's the first one, is get that done. If you've got sort of a little small side hustle and a main job as well, getting it in early before, say, October is a good idea, because you can sometimes opt to have some of the tax collected through your job's tax code. It's not something I'd often recommend, actually, because I think it complicates life, but some people prefer that for the cash flow benefits. So if that's you, get your tax return in early, that can also help. And if you're in the zone where you're paying twice a year, so if you have to pay normally, for most people, if you have to pay more than £1,000 of tax at the end of the year, you end up having to pay twice a year. So they ask you for the next sort of upfront amount. So they call it payment on account, but you have to pay twice a year in the January and the July. So if you've got July payment, sometimes it's worth doing the tax return before July, so you can see if that payment's correct. It could be that actually it's not correct and you're going to owe more in January. That payment will never change. It'll never be more, but it could be less. Because what they do is they guess that actually so if you have a tax bill this year, you'll have to pay, and it's over £1,000, let's say it's £1,200, you're going to pay the £1,200 you due in the January next year in 23, but they'll also want another £600 on that day for the next tax year, and then another £600 in July of next year. I know it can be a bit complicated to explain, but let's just bear in mind that you're going to have to pay in advance based on what you earned in this tax year. They just presume you're going to earn the same again. So if this was kind of you a year ago, the amount you'll be paying in July this year is based on last year's figure. And of course, you could have earned less. You could have earned more, obviously, but you could have earned less. And as a result, it could actually lower that payment. So do get it in early, and it could affect it. And sorry, that's a hard one to picture sometimes. But yeah, just know that if you got a payment in July, doing it early can be a benefit, and certainly no downside to that. Now, when it comes to gathering all that paperwork, the other reason it's good to talk about this maybe in June rather than April is, for a lot of people, if you've got a main job, you might have medical insurance, car benefits, some other sort of benefits. And there's a form called a P11D. Now, the employers don't legally have to give that to you until a bit later in the year, so you might not have had it, even now, you might not have had it quite yet. Most bigger payroll people will have already done it, but if you're in the small business world, you probably won't get it to about middle of July. So do keep an eye out for that. It's an often missed piece of paper, so that's around, but the minute you get that, obviously get it all done. Other basic thing for landlords out there and people that own rental properties, if you're going to sell a property again, there is a very special tax return you need to do. They don't give you a lot of time to turn that around. You only get 60 days from completion to do it. It's a separate thing. You have to go on your online portal, create this new return, and you always have to do like a tax return in advance and pay any of the tax in advance, and then you have to then put it on your tax return later as well. So just know that, keep that in the back of your minds. If you are selling a property and there is a gain that's taxable, you need to keep your accountant, solicitor, everybody involved with that quickly from the point that it does, because it seems like a lot of time, but it really isn't. It's quite a lengthy process to get all that done, calculate the gain sorted, especially if you've held that property, say, for some time. You might have to go around hunting for all the different figures and costs that you've improved the property by and all this. So yeah, just remember that if you're going to sell a property at a gain, there's a special tax return to do. Keep that on your radar throughout the tax year. Now let's talk limited companies for a minute. So as I said at the beginning of the video, if this isn't you, still worth very briefly listening in, because there's some key points here I'm going to talk about elsewhere as well. First one, director's salary. So it's very common to have a situation where you have a split of the way you take your money. So you've got your money and your profits there, and you think, do you know what, I'm going to pay myself some money, and there's plenty of videos on the channel on this, but you're likely to split it between salary and dividends. So you have some declared payroll on your PAYE scheme as it's known, and the rest of it tends to come out in dividends. Now the most tax efficient way of doing that, of splitting it, varies year on year, and it varies particularly at the moment because they announced a change to national insurance thresholds and the way this works with individuals. What it means is now there's a variable salary somewhere between £755 and about 1048 is kind of the bracket for the most efficient salaries for many people. But actually we've been doing some maths internally in some scenarios where we've seen where people have got small side hustles, where actually those brackets can change based on their circumstances. It's very difficult to give you the exact amount because it depends on how much you want to draw out the company, when you want to draw it out, do you need every penny, and all this kind of stuff. But do know that you need to review your salary and have a look. And if you're working with an accountant, definitely talk to them about that to make sure that you're all comfy, that kind of meets your needs, because there's lots of opportunity to do different things. But that's a big tax saving opportunity for this year. And you might already, if you've already had April, May and June's, you might want to review it in July, because it could make a difference when this new bracket comes in for national insurance. So check that out with your accountant. Big one if you're looking to invest in equipment this year. There's something called the Super Deduction. Awesome name, right? I'm waiting for the Mega Deduction. It's like Big Brother or something to come out at a later date. But at the moment, the Super Deduction's out there. And what that means is if you're looking to invest in equipment, say you want to buy a new camera, a MacBook, a new van, brand new, I'll say new, has to be new, you get 130% tax relief off that. What that really means in real terms is everything's 25% cheaper. So if you go buy a MacBook, you're going to get 25% off the price in tax effectively. So really good time to do it. As always, I'd never go and say to you, go spend money and waste money just to save tax, because obviously you've still got to fund the 75% for the piece of equipment. But if you were looking to invest in those kind of bits of equipment, now is a really, really good time to do that. So it's called the Super Deduction, and as I say, it only unfortunately applies to limited companies and to new products currently. Now, big one if you're not VAT registered. If you're under 85,000, it's not so much an opportunity, although it could be. It's more often that it's a potential pitfall, and that's to make sure that you're tracking your income throughout the year. So if you don't regularly have accountant check-ins, or you've not got a bookkeeper that's keeping an eye on this for you or anything like that, it's very easy. We see at least a few a year where someone's gone over £85,000 turnover in a 12-month period. And I know there's other videos we've done on this, but it's not 12 months, then it's a zero reset, and then you can go for 85k again. It's, it moves like this throughout the year. You take off the oldest month, put the newest month on, and it sort of shifts. So this £85,000 threshold, you have to then, for most businesses, be registered for VAT. And what happens to a lot of small businesses that don't keep an eye on this is they realise 4 or 5 months down the line they should have been registered, and then they've got back VAT to pay, and it can get quite messy. There's penalties to pay for late registration. So just keep an eye on it. That's kind of the tip for this, is keep an eye on that threshold as you're going throughout the year to make sure that you're not VAT registered. The other thing to do is consider the maths of whether it's a good thing, and this is the opportunity part, to be VAT registered, because for some, and again, there's videos on the YouTube channel on this, but have a look and just think, is there an opportunity? So very, very briefly, if you're business to business, and they're slightly bigger businesses, there's quite often a good reason, paperwork and filing aside, to look to be VAT registered voluntarily, because you don't have to wait till 85,000. But for most people, if you're working direct with a customer, direct with the consumer, direct with Joe Public, whatever you want to call them, then in which case you tend to wait until you have to. But again, check out some videos on our channels for that. But yeah, so monitor your threshold and look for the opportunity of whether it's a good idea or not to be VAT registered. Slightly less exciting, so don't switch off, pensions. So a lot of people contributing to a pension is a good thing. So if you're a limited company, there's a really good way to contribute to a pension quite often, and that's by making employers contributions. So rather than you as the individual director owner make the contribution. There's some benefit to that as well, but generally for most people in a tax efficient scenario, you tend to have the company make an employer's contribution into your pot directly because it actually counts against your profits. You can reduce your corporation tax bill and it doesn't touch your own income, so you're not paying dividend tax. So there's like quite a few decent reasons to do that. The wider question though, and that's in the realms of financial advisors, is whether it's a good idea to pay into a pension personally. That's something for you to investigate, whether it's actually worth the pension full stop. But if you did have to go and wanted to do that, then yeah, the company making a contribution is a really good thing to consider. And there are caps in the year of how much you can contribute to a pension each year, although quite often there's these clawback rules where you can kind of look at it over a 3-year period, but there's terms and conditions with it and all these things. But just know that there is an allowance. Your allowance will vary depending on what you've contributed recently, and it's worth reviewing. The great thing about this was the limited company owner is as long as you get it done before the 5th of April, you don't have to think about contributing every month. You can kind of do it in different payments, one payment, whatever you want to do. So consider that, look into it, do your research, and if you've got an accountant, of course, speak to them. Big one, it's not so much a tax one, but it's more about opportunities for you thinking of using like the super deduction or contributing to your pension or all these kind of other things we spoke about, is you tend to need to have a plan. And I talk about this a lot, and I've been talking about this a lot recently because of the kind of the state of the nation where we are at the moment in terms of, it being tough trading conditions. People are worried. There's a lot of angst around, is my business going to be okay? What does it mean for me? How's my pricing? A lot of this can be alleviated with a clarity of mind by just doing a plan. It doesn't have to be an amazing, complicated plan, but a spreadsheet would be a good start. 12 months, what does my cash look like? What each month, what am I spending out? What's coming in? What am I expecting in? How does that look on my cash balance? And sometimes you'll be surprised pleasantly that it's going to be okay for you. And sometimes it might also give you the kick that you need to think, this isn't going to be good unless I do something about this. More customers, more pricing, less costs, lots of things you can do, but the clarity of knowing is really important. So, and then you might look at it and go, cool, I've got enough cash, I can go and renew those equipment, make the use of those tax savings, pay into my pension, those kind of things. So whether you're a sole trader or limited, that's always an absolute must for me. Have that kind of just basic financial plan. And if you do want to kind of just a rough spreadsheet template, if you just Google, I'll put it in the comments on YouTube below, but if you Google Heelan Cashflow Basics, there's a little downloadable link there and it'll give you a really, really sort of quick and dirty spreadsheet that you can use to help plan your cash flow. And then finally, kind of on limiteds, just remember that what you have got is effectively an increase in national insurance. It's a 1.25% increase for the health and social care levy that was introduced. So your general bill's gone up. If you employ a team, that's already gone up. It's now 15.05% is the contribution you're making as the employer to the national insurance pot on their money. But this also applies depending if you've got director's salary, could apply to you. So it's just worth bearing in mind that that's there on any of your planning. But for you, particularly as a limited company owner, it also affects your dividends. So they've to make sure that it wasn't, because dividends are national insurance free. So which is why people quite often use them as ways to pay themselves. So they added a 1.25% to make that not obviously clearly better. So but it will affect you. So when you think about your planning this year, just think there is that extra 1.25%, and what you don't know is whether that's going to increase. So again, you try to maximise the use of your basic rate band. So if you're a basic rate taxpayer, and by that I mean you earn under total income, say of around £50,000, then you want to make sure that if you can, that if you're on a 30,000 and the company's got enough to pay you another 20,000 dividend, often that's a really good thing. Yes, you're going to increase your tax bill, but if you go through the next tax year and haven't used it, you've lost it. There's no kind of clawback on that. That allowance dies with you in that year effectively. So just make sure that, you're planning out your income as the year goes on and thinking if I'm close to that basic rate band, that 50K where it's kind of cheap money, it's definitely worth playing around. And there's other videos on the channel about how you can maximise that with dividends, but ultimately there are ways to declare and note a dividend without physically taking the cash and things like this that can really help make sure that you use those bands. So there you go. That's a massive, massive opportunity to look forward as the year goes on. So sole traders, many of the things I just mentioned on limited company apply. So keeping an eye on that VAT threshold, do not go over, do not let it sting you, but also the opportunity to consider whether it's voluntarily worth you registering for VAT as well. I mentioned about cash flow planning, same sort of thing, cash flow planning, making sure that you have a plan to know whether you're going to be okay or not, whether you can reinvest in equipment. Now, why the super deduction that I mentioned in the limited company bits is not available to you, unfortunately, there is still something called annual investment allowance. That still gives you 100% tax relief in year one on equipment. So it's still really good if you need to refresh equipment. So that's still there. But again, in order for you to know if that's possible and whether that's going to be okay, some sort of financial plan would be a really, really good thing. And financial plan, it sounds more complicated than it is. It's a simple spreadsheet with 12 months on it, right? And you can just see what your cash looks like over the years. So that's important. And then for you, opportunities wise, make sure that when you're looking at this, and this is really why I think having accounting software is a big deal for even for sole traders, or a really good spreadsheet that tracks your profit, is if your profits are looking over about £35,000 a year profits, not sales profits, then it's a really good time to start thinking about whether you should be a limited company. And that is very fluid. Like, we've seen limited companies where 12 grand a year makes sense of profit, and I've seen them where actually for cash flow purposes you want to be in the 40, 45 because of the way they work, and CIS deductions and all this kind of stuff. So just know that if you're in that 35k profit bracket, and that you don't have to wait to the end of the year. In fact, I wouldn't wait to the end of the year. I'd start thinking about it whenever that occurs. Start talking to accountants, doing your research, and just seeing, is this going to be a good idea for me? Because it's quite a big opportunity, that one. Or certainly if you left it and you ended up at 60, 70k profit, you'd kick yourself with the money you could have saved being limited and done well. So not only are you tracking your VAT turnover to make sure that you're not going over the VAT threshold by accident, you're also tracking your profit to make sure you're not missing an opportunity to start talking about limiteds. And just like before, you've got the problem where you've got an increase of 1.25% on your national insurance in terms of the health and social care levy. And really the only way to tackle that for you is to make sure that you've got all your tax deductions in that you should to keep your tax bill low, because that national insurance is what they call the class 4, is actually done on your overall profits. So lower profits, lower national insurance bill. So and using some of those things like investing in new equipment will help bring those profits down if you need that equipment, and just making sure you're capturing everything. That's pretty much all you can do on that front. But yeah, just know that it is there, it is going to hit you. So again, if you've just done, not that it matters for 21, 22, getting your tax return in early is going to help you then know what your tax bill is. And if you've got a financial plan, hopefully you can kind of build all this in and be ready for next year's tax bill, which is going to be slightly heavier unless you start doing these things where you're investing in equipment and new vans and things that you may need. That will really help bring down that impact of that health and social care levy. So if you're an employer, one key opportunity to remember is to make sure if you can claim employer's allowance. And there's other videos on the YouTube channel on this in terms of it's up to a £5,000 a year national insurance saving for your company. And this is really when you've got a team. So it doesn't, but that team could be you and your significant other that are in the business. It depends on how much you pay each other, and there's some qualifying conditions. Check out the other video. But ultimately you have to sort of claim every year this £5,000, and it's up to £5,000, but it's not like they suddenly repay it to you. It gets knocked off your national insurance bill, but check the video out, you get more details on it. But you have to submit a report every year. So that's another sort of key point at this point in the tax year, to remember to have submitted that report with the right tick box. It's called an EPS, an employer's payment summary, and it will make sure that Revenue and Customs know you intend to reduce your bill by that up to that £5,000. So big one. Don't miss out. We see at least a couple of businesses a year where that's just not been claimed, and it's nice for us to show someone, but they could have had the cash in their pocket earlier. So yeah, check that out, employer's allowance. And aside from the usual kind of stuff, like if you want to save money, there's ISA allowances and all this kind of stuff you can do. It doesn't excite me particularly as from a business owner's perspective, but they're all there. So there are some more basic tax planning. But for me, they're kind of the business opportunities and potential pitfalls that present themselves and that should start thinking about as the tax year goes on. I'm sure there's more that we could have mentioned, but obviously it's quite a long video to go into all of this anyway. So there you go. Hopefully that's some tips. And if you've got any questions, please do drop them in the comments below and we'll do our best to answer them where we can. If you enjoyed this type of video, make sure to share it with your network, and I'll see you in the next one.